Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Welcome back to the Ask Ralph program. Now that the tax reform bill has been signed into law, I thought it'd be a good opportunity to talk about some of the nuances related to that. And there was an article on the Accounting Today website back on December 20th. It was written by Ben Steverman and Suzanne Woolley from Bloomberg News. And what they do in this article is talk about how this tax reform bill will affect 8 U.S. families. So let's get started. The bottom line, though, before we get started, is that the next year, a majority of Americans will, in fact, get a tax cut. So don't listen to the news when they say to you that's not going to happen. In fact, 4 out of 5 taxpayers can expect a reduction. That's according to the Tax Policy Center. Overall, the average taxpayer should see an average after-tax income rise by 2.2%. So your overall after-tax income should rise by 2.2%. Now, many of the lower and middle-class income tax payers will get a tax cut, but it will be small, so you might not notice it as much. That's if you have the earnings between $48,600 and $86,100, because effectively those people are going to get a 1.6% bump on average. Now, if your income is over $300,000, you're looking at a 4.1% boost. But let's talk about how some of the different groups in our society will fare by this tax cut. Let's start first with multimillionaires in New York. So these typical people have a jumbo mortgage, and we're assuming a 4% interest rate, and they generally take a $40,000 deduction on their mortgage interest. They pay property taxes of $96,250 and state income taxes of $135,360. And in this particular case, for this example, these people made annual contributions totaling $100,000. Now, with this new tax law, they're going to pay a bit more because they're losing some of their key deductions, especially the ability to put down more than $10,000 in state and local income taxes. So if we added their property taxes and their state income taxes together, that'd be well over $200,000. But now with this rate reduction on the SALT area, state and local income taxes, that offset drops in the tax rate, because they go from the 39.6% rate to the 37%. That's what we call the marginal rate, the rate paid on additional extra dollars earned. So city taxes for these Manhattan dwellers would work out to almost 4%. Combine that with the top federal rate and top state rate, and you get a marginal rate close to 50%. So bottom line is the multimillionaires in New York are going to actually see, in this particular scenario, a higher tax burden because of the Tax Reform Act. Let's look at another scenario, and this is the second home scenario in California. So we have a married couple has a primary residence in Malibu, California, and a second home in Lake Tahoe. The property tax on the Malibu home is $15,860 per year, and they pay $4,896 on their second home. They deduct a total of $40,000 in mortgage interest for 2 homes, and they give $50,000 a year to charity. This couple, again, would lose almost $86,000 in deductions under the new tax bill. Nonetheless, other changes, especially the drop in the top tax rate, means their effective tax rate creeps up only, say that 10 times, by 0.5 percentage points. So overall, again, second home scenario in California, wealthy taxpayers, they're going to pay more. Now let's talk about the small business owner in Pittsburgh. This married couple with a small manufacturing business in Pittsburgh has $300,000 in what they call pass-through business income. We talked about this before. Their deductible mortgage interest adds up to $6,000, and their property tax is $8,600, and they give 5% of their income to charity. Now, these taxpayers get a big benefit from the new 20% deduction aimed at a pass-through business owner who pay their income taxes through their individual tax returns. So these are the type of people that will see a significant tax decrease because of the fact they're going to be able to deduct 20% of that $300,000 in pass-through income right off the top of their return. Let's talk about another scenario, and that's the suburban family living in Westchester. A married couple in a New York suburb has estimated state taxes of $17,290 and their annual mortgage interest deduction is $14,000, and they pay property tax of $13,750, about the same amount they donate to charity. While the tax bill takes a bite out of this family's deductions and exemptions, they would benefit from enhanced child tax credits and avoiding the AMT tax. And that's because the threshold for this AMT tax applies a little bit better, raises those thresholds until 2026. And in this case, even though their mortgage interest is going to still be deductible, the property taxes and their state income taxes are over at $10,000. But because of the additional child tax credit and the reduction in AMT thresholds, these taxpayers will probably make out okay. Our next scenario is a single person living in Manhattan. So this particular New Yorker pays estimated state income tax of $8,148 and gives about $6,500 to charity. The final tax legislation is more generous to this taxpayer than the bill that originally passed the House and Senate. That's because it permits the deduction of state and local income taxes up to $10,000. Now, when they were talking about putting this bill together, there were some legislators that wanted to eliminate the state and local income or SALT taxes altogether. So the original proposal scrapped the income tax entirely and allowed only a $10,000 deduction for property taxes, which this renter doesn't pay. So in this particular case, this New York person estimated state income taxes and $6,500 to charity is still going to benefit from this tax plan because we don't have those caps based on the fact they only paid $81.48 in state income tax. Our next scenario is a married couple in Austin, Texas. So this couple rents and has income of $100,000. They give $5,000 a year to charity. The bill eliminates their personal exemption. That was an automatic $4,050 deduction for each family member. But for this couple, that loss is offset by rate cuts and a near doubling of the standard deduction from $12,700 to $24,000. So in this particular case, since they rent, they're not paying mortgage interest, they're not paying property taxes, so their $5,000 in charitable giving is really of no value to them because with this new tax law, they raised the standard deduction to $24,000. Now, the next one. A median income person living in Oregon. This Portland, Oregon couple earns close to the median household income for the U.S. Their property tax bill is $1,688. Their deductible mortgage interest is $3,000, and their estimated state income tax is $4,744. Because this couple has few deductions, they benefit from the higher standard deduction, netting a tax savings of $949. So this is the scenario that they've talked about a lot in the press where this particular couple will save $949. And the final one here is a couple that's renting in Milwaukee. Now, in this particular case, this family ends up with a negative income tax rate because from the enhanced child tax credits, which are refundable, that means that subject to limits, low-income taxpayers are able to get larger refunds than they pay in income taxes. So that was just a few of the type of things that are going to happen with this scenario, and I hope this helps you, and we'll be expressing more of these things as we move forward.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.